Welcome my YouTube friends. Thank you for watching my video. Welcome to my YouTube channel, Valuepedia, the #1 channel about finance and entrepreneurship. In this YouTube channel, we will be frequently posting videos about finance and also entrepreneurship. All knowledges that you need to learn and know about finance and entrepreneurship. In today's video, I will be sharing with you about how to understand and use life insurance for financial security. Before you continue watching this video, please help me to like, subscribe, smash the ring notification, and also share. A lot of people, when talking about life insurance, they have misconception. They always associate life insurance with death. In fact, life insurance is not necessarily about that. In fact, you can use life insurance as a tool for your financial security. So what is life insurance? Life insurance is a contract between an insurance policyholder and an insurer, where the insurer, in this case is insurance company, promises to pay a designated beneficiary a sum of money upon the death of an insured person. Now let's look into this illustration here. You have insured. Insured is basically assuming you are the one who buy insurance. You insured your life, you call insured. Insurer is the insurance company. Then you sign a contract with insurance company. You transfer all your risk to insurance company. In return, in exchange of that, you pay them premium payment. So when you submit the application, insurance company will then, before decided to take on you, they will go through the what we call it underwriting process. From the underwriting process, they will check your medical record, the medication that you take, if you have any medical history, your blood exam, if you have your driving record, including if you have any background for any felony and misdemeanor. So after checking all this information, if the insurance decided that, you know what, it is okay for them to accept your risk, then they will issue you approval and then issue your insurance policy. So insurance policy is a contract, binding contract between you and insurance company, which stated that you pay this amount of premium. If something were to happen to you, then they will give to your designated beneficiary the amount of coverage that you actually in contract with them. So why life insurance is so important? It protects your spouse and children from the potentially devastating financial losses that could result in something happen to you. Now, let's understand the relationship between wealth and responsibility. If you see wealth, right? When we are young, we don't have a lot of wealth. We are just started out. So if we look at the curve, the wealth is actually low. What our goal is, we want to work hard so that we can build a wealth curve right here. But while we are working hard to build a wealth curve, on the other side, we also have another curve that we have to consider or think about is responsibility. In this case, you see that you have mortgage, you have kids, you have to think about education and also car loan. So in this situation, we have built up already $950,000 of liability. That's why our shoulder is very heavy. In order to reduce our responsibility, we then need to build a wealth curve. Assuming that we have already saved half of it, then our responsibility actually go half the way down. Eventually, hopefully, our house paid off, our kids graduated, and also our cars actually paid off. Now, when we have low wealth, high responsibility, our situation is called less secure. But once we pay off everything, our situation is called more secure. Now, during the process of moving from here to here, two things that could happen, which is right here and also right here, that we cannot predict, which is, what if we have low wealth, high responsibility? What if we were to live too short, just like what happened for the last 2 years with the pandemic hit, the COVID-19, right? All of a sudden, some people get sick, and 2 to 3 days later, they passed away. So death is something that we cannot predict, right? So when we have low wealth, we have to learn how to transfer our responsibility or risk to an insurance company by paying a small amount of premium. So During the time that we are in secure situation, life insurance is an investment for us. Again, once we pay off everything, life insurance is no longer important to us. What is important to us now, we have to think about when we retire. Will we have enough money to retire? What if we live too old, 80, 90 years old? Can we expect our kids to take care of us? This is something that we also have to think about in terms of financial planning. If you liked the video so far, please subscribe, hit the like button, smash the bell notification, and share with your friends. Now, how do you decide how much life insurance do you actually need? Now let's look into this situation, a husband and a wife, right? And the way how you calculate the amount of life insurance that you need, you use the DIME method. D stand for debt, I stand for income replacement, M stand for mortgage, E stand for education. So let's say in this situation, husband and wife, a family, they have debt of $30,000. So if the husband has $30,000 debt, then the debt will also be part of their wife as well. And then let's say the husband make $100,000 of income a year, then you need to times 10, which is 10 years or 12 years. Why is that? Because if something were to happen to the husband, at least the wife will have 10 years or 12 years to get by. Or she can use this $1 million to invest into a interest bearing account. So even the breadwinner is no longer there, she will have interest from the $1 million to get by. As a mortgage of $500,000, and also education, let's say assuming for your kids' college education, 4 years will cost $300,000. So when you total this all out, the husband, the insurance needs will be $1.83 million, and the wife is $1.63 million. So what does the $1.83 million means to the family, to the wife and the kids, right? That means that something happened to the breadwinner, the husband can make sure he doesn't leave any burden to the family with the debt. He can make sure there will be food on the table for the wife and the kids. He can also make sure there's roof on top of the family. And last but not least, even he's no longer there, he can make sure the kids will still be able to pursue the best education that he had planned before. So that's how you actually calculate how much life insurance do you actually need. Now, what type of life insurance that are actually suitable for you, right? What type of insurance are out there? Life insurance is differentiated into two categories, which is the temporary life insurance and also permanent life insurance. In the temporary life insurance, you have two kinds, annual renewable term and also level term life. Annual renewable term, whereby you renew your life insurance policy every year. This is an old policies that happened many years ago. Nowadays, nobody really buy this annual renewable term anymore because it can get too expensive, because by the time, let's say you renew every year, by the time when you are, let's say you have it when you're 20, by the time you keep renewing at 50, you may not be able to afford anymore because the premium will be too high. Then insurance company design another one, they call it level term life. They have 10 years, 15 years, 20. There are some company have 40 years old. But not everyone can purchase the 40 years because depending on your age. Let's say when you hit at a certain age, insurance company may not want to sell you the 40-year term life anymore because it will be too risky for them. Now for that level term life, meaning that assuming you have a 10-year level term life and you pay a fixed premium for that 10 years level term, it will pass on within that term period, then the insurance company will pay to a family. However, it will pass on after the 10-year period, then our family will not get anything because there's no longer valid because the 10 years already up. Now another category is called permanent life insurance. So which is they have a few kinds: whole life, universal life, variable universal life, and index universal life. So which is permanent life insurance is nothing a cash value policy, whereby you have a cost of insurance and you also have cash built in it. So in a permanent life insurance, you slightly put more into your policy because there is a savings component in it. So in between whole life, universal, variable, and index, the difference is the way how the interest is credited to your cash value. In whole life, you only get about 3 to 4% interest rate. The interest rate is determined by the insurance company. Another one is called universal life. The interest you will get will be adjustable interest rate, depending on the interest environment, like the Moody rate, right? And variable universal life is based on the stock market, as you know, as the word say variable, so the interest is fluctuate depending on the performance of the stock market. And the next one is index universal life, whereby your cash is mirroring the performance of index, either S&P 500, NASDAQ, and also other indexes as well. So I will be discussing the difference into each type of this insurance policy in detail in my next video. And I'll also explain to you how does insurance company calculate the cost and how do you decide which policy is actually the right type for you. Now, how to decide which type is suitable for you, right? So in order to decide that, first of all, what you need to do is you have to set up your budget first. And you have to look into, in a month, after you pay your mortgage payment, your daily expenses, and also your utilities, how much money is actually left that you can contribute to your life insurance policy long term. Because life insurance is not about a month, 2 months, but it's a long term, right? How much you can afford a month. Because if you only can afford 2 to 3 months and the third month you cannot afford, then the policy becomes invalid, which is not good. The second thing also, you have to decide what is your liability amount, the amount of liability that you carry, and how much you want to leave to your family. So as I said to you earlier in our previous slides about, you know, the dime method, right? And also, you know, what is the mortgage level, how many kids you have, what education will cost your kids when they go to college. Those are the things that you have to consider. And last but not least is your goal. What is the ultimate goal that you want to achieve of your life insurance? Do you also only want to use it specifically for life insurance? Or you think about also, what if we get sick, we don't pass on, we are in the long-term care situation? Is it something also important to you? The second thing also, what if we are in a critical illness, like liver transplant, stroke, heart attack, cancer, and many other things? So if we do not have that component into our policy, then if we are sick but we don't pass on, our life insurance will not, policy that we have will not work for us. Another next thing is also, do we want to save, do you want to contribute to the life insurance policy as a retirement plan as well? Because you can also use life insurance as part of saving investment, no tax, which a lot of people, especially 10% of the rich people, put majority of the money that they have into a life insurance policy. So this is some of the things that you have to consider. You have to sit down with your financial planning to go over all of this. So that's the end of the video about how life insurance works. In my next video, I will be discussing with you about how life insurance, the cost of insurance works, the difference between each type of policies, and how do you actually implement it into your financial planning. So if you like this video, please don't forget to subscribe, hit the like button, smash the bell notification, also share to your friend. Thank you for watching. I'll see you in my next video.